Okay, let's dive into Sea Limited. Their recent stock performance, well, it tells a wild story. It might just make you do a double take. This company, yes, that Sea Limited, has nearly quintupled since early 2024. That's a mind-boggling 400% gain over the past 18 months. It's made it one of the absolute best performing stocks in that period. But here's the kicker, the really remarkable part. Despite that incredible surge, it still remains, what, 58% below its all-time high from back in 2021? So this isn't just a comeback story. It's really a saga, you know? A company that faced some profound trials, navigated a truly severe downturn.
Exactly. And what's so compelling about Sea Limited's journey, I think, is how it didn't just survive what our sources call a perfect storm. It seems to have actually emerged stronger. You hear this term anti-fragile.
Right.
An anti-fragile company doesn't just bounce back. It actually learns from the stress, from the pain, and evolves because of that adversity. So our mission here in this deep dive is really to unpack precisely how they did that across their core businesses, gaming, e-commerce, digital finance, and maybe figure out what unique resilience this whole experience might have baked into their long-term potential.
Yeah, to really appreciate the comeback, we kind of have to revisit the dizzying heights they reached first, and then, of course, the precipitous fall that followed. During the pandemic, Sea Limited just saw this dramatic ascent, didn't they?
Oh, absolutely.
Their mobile gaming, e-commerce, digital payments businesses, they all saw huge increases in adoption. It really seemed like they could do no wrong for a while there.
And what's absolutely critical to understand here is the engine behind all that. It was the massive profits from their huge hit video game, Free Fire.
Right. The game.
Those profits were crucial. They were basically fueling the super aggressive growth of Shopee, their e-commerce arm, which was unprofitable then, and also their digital finance business, SeaMoney. I mean, management at that point was even setting sights on expanding into tons of markets way outside Southeast Asia.
That kind of ascent sounds amazing, but well, as we often see, what goes up can come down pretty hard. Sea Limited wasn't immune. So what did that perfect storm actually look like, and how quickly did things turn sour?
Well, when the global economy started to reopen, it just unleashed this sort of cascade of challenges. You had inflation shooting up, interest rates rising, and maybe the most critical hit for Sea. Consumers started spending significantly less time playing Free Fire. And that decline, I mean, it was a massive deal because, as we said, its profits were essential for subsidizing Shopee and SeaMoney's growth. Without that strong tailwind from gaming, the company very quickly found itself facing just enormous losses. It created a truly dire situation. It was like their golden goose just stopped laying eggs overnight.
Yeah, and faced with something that dire, that's when you really see a company's true character, isn't it?
So what was their immediate response? I mean, the sources describe it as a hard pivot, which sounds pretty drastic. Oh, it was incredibly decisive, almost like performing emergency surgery on the business. The specific actions they took were, frankly, brutal. They cut marketing expenses to the bone, and we mean deep, severe reductions. And they significantly raised seller fees on the Shopee platform. This wasn't just tweaking things. It was a clear, sudden shift in priorities, away from growth at all costs, squarely towards survival, towards profitability. And the immediate impact was pretty stark. Growth definitely slowed down dramatically in some areas, but the losses, they lessened significantly. And here's where you start to see that resilience poke through. After facing those huge losses, the company actually managed to turn a profit for the first time in Q4 2022.
Wow, Q4 22, that's a quick turnaround.
It was, and that was a monumental turning point. It proved their new kind of radical approach could actually work.
That shift from growth at all costs during the boom years to this stark profits at all costs when the storm hit, it's undeniable. But what do you think was the biggest internal challenge in making that pivot? Was it like a cultural thing? Or maybe convincing investors who were just used to that hyper-growth narrative?
Oh, the internal challenge must have been immense. I mean, just imagine telling teams who were used to relentless expansion, aggressive targets, that now they had to shrink budgets, that every single dollar of marketing spend needed to justify itself, like, immediately. It must have required a complete cultural reset, almost overnight. But I think that near-death experience, you could call it, forced a discipline they might never have achieved otherwise, in a normal bull market. And that's arguably made them inherently stronger now. They're no longer dependent on just one segment like Free Fire to prop up the others.
Right, self-sustaining.
Exactly. Each part is pulling its own weight now. And that's really the hallmark of becoming that anti-fragile compounder we talked about earlier.
It's one thing to talk about these strategic pivots, right? But the real test is always in the financials.
Yeah.
The proof is in the pudding, as they say. So how did this newfound discipline, this focus on profit, actually translate into their Q1 2025 results? The numbers, I assume, tell the story.
They certainly do. The headline numbers alone tell a really powerful story. You've got total top-line growth of 29.6%, pretty healthy.
Okay.
But then look at adjusted EBITDA. It exploded higher by an impressive 135.9%.
Yeah, 135%.
Yeah, this isn't just, incremental improvement. It's a profound shift in their financial health, a fundamental change. And if we break it down by segment, the performance is even more telling. Let's see, e-commerce, so Shopee, 28.3% revenue growth, good. But the EBITDA, it flipped from negative $21 million in the prior year quarter to a positive $264 million.
Swing.
Massive swing. Then digital financial services, which interestingly they've rebranded as Monee.
Well, Money.
Yeah, which kind of speaks to their broader ambition, maybe beyond just payment processing, hinting at a more comprehensive financial ecosystem, perhaps.
Interesting point.
That segment showed impressive 76.5% revenue growth and 62.3% EBITDA growth. So strong on both fronts.
Very strong.
And finally, digital entertainment, Garena, which includes Free Fire, also strong,
Wow.
51.4% bookings growth and 56.8% EBITDA growth.
So across the board, really.
Pretty much. But what really stands out beyond the individual segments is the sheer surge in overall profitability. Get this. For about $1.1 billion in incremental revenue they brought in last quarter, a remarkable $545 million fell directly to the adjusted EBITDA line.
$500 million.
Yeah, that suggests the company is operating with nearly 50% incremental EBITDA margins today.
50%.
Which is a clear indicator, I think, that Sea has built a really robust, competitively advantaged asset. It means they're not just growing revenue, they're retaining an unusually high percentage of each new dollar earned.
Right, which points to either a strong pricing power or some serious cost efficiencies.
Exactly, things that rivals probably can't easily replicate.
Okay, so beyond the really obvious cost cuts, which were clearly necessary, what were some of the less visible moves? Maybe the more strategic things they did that set them up for this kind of longer-term profitable growth? What's the sort of unsung hero of this comeback?
That's a great question. It really seems to be a combination of smart operational investments and thoughtful expansion where it makes sense. In e-commerce, specifically with Shopee, they've invested heavily in operational efficiency.
Yeah.
And this isn't just about cutting the fat, right? It's about becoming leaner, meaner, more effective. They've focused relentlessly on things like fast delivery and consistently reducing their cost per package. The goal seems to be becoming the absolute lowest cost provider for many types of e-commerce goods in their regions.
That's a powerful competitive advantage if they can sustain it.
Absolutely, a significant moat. And it's not just cost control either. They've seen really strong growth in high-margin advertising revenue on Shopee.
Ah, the ad revenue.
Yeah, it surged 50% last quarter. And this seems to be driven by a couple of things. New AI features making their ad tools more effective for sellers.
Okay.
And critically, a growing, engaged user base. You need the eyeballs, right? That offers a captive audience for those advertisers. Meanwhile, their digital payments segment, Monee now, has shown really steady growth, both in digital payments itself and also in unsecured loans.
Okay, the lending side.
Yes. And sources suggest they've been very careful here, focusing on selecting good credits.
How do they do that?
Well, they seem to be leveraging the robust data they have from the Shopee platform, purchase history, payment behavior, things like that.
Makes sense. They had the data.
Exactly. And what's interesting is their strategic expansion beyond just Shopee users. They're growing non-Shopee payments and loans in the region, and apparently also venturing into some new financial products as well, broadening their reach. But maybe the most strategically fascinating piece, going back to it, is Garena and Free Fire.
Right, the original cash cow.
Yeah. Remember, its bookings had really sunk during the downturn, below $500 million a quarter. They steadily recovered to just over $500 million per quarter for about 2 years. But then, in Q1 2025, there was this big jump back up to $775 million in bookings.
Wow, quite a resurgence.
It is. And management even noted that the number of daily active users for Free Fire are now back close to the pandemic average.
So the players came back.
It seems so. And this doesn't appear to be just luck. Here's a really interesting strategic insight our sources highlighted. In Q1, Sea unveiled a new anime integration,
Okay.
specifically with the Japanese studio Naruto for Free Fire, and management shared that they had actually been working on this specific project for 2 years.
2 years for an integration.
2 years. That kind of foresight, that patient execution over 2 years, it really demonstrates a deep, long-term strategy. They're aiming to maintain Free Fire not just as a fleeting hit, but as an evergreen annuity stream, almost like a recurring subscription for entertainment, you know?
Keeping it fresh.
Exactly. Consistently refreshing it, adding major content drops like this to keep users engaged for years and years.
Yeah.
They're definitely playing the long game there.
Okay, let's talk about where things stand right now, especially the valuation. Because after that huge run-up, the market cap is around $92 billion. It's trading at, what, 5.4 times sales and maybe 60 times this year's earnings estimates? Which, might look expensive on the surface to some people.
Yeah, those multiples definitely grab your attention. But a key insight that emerges from our sources is this. It's often a mistake to sell a truly high-quality company, especially one that's demonstrated this kind of anti-fragility, this resilience, even if its valuation appears high at a particular moment. The market quite often underestimates the long-term compounding power of businesses like these.
Right. Quality costs, perhaps.
Perhaps. And if we connect this to the bigger picture, Sea also seems to have a really long runway for growth ahead of it. Just look at the Southeast Asia e-commerce market. It's projected to grow at something like a 14% annualized rate through 2030. That means the market itself will more than double in size.
Plenty of room to grow within their core market then.
Definitely. Plus, Sea is also growing strongly in Brazil. That's become its most significant market outside Southeast Asia. So there's geographic diversification happening too. And let's not forget, Sea once had these grand ambitions to enter many new markets during the pandemic high times. Remember, some European countries, India, before they had to scale back.
Right, during the pivot.
Exactly. Yeah. But now, as the company becomes comfortably profitable, generates strong cash flow. Well, it's not totally out of the question that Sea could choose to re-enter some of those markets down the line.
Interesting possibility.
So while hitting a new all-time high stock price might seem a bit far-fetched today, given how far it fell, the company certainly has the potential to continue growing profitably. And it could potentially see a new high within this decade, offering, a potentially solid long-term return for you, the investor watching this space.
So wrapping this up, what's the sort of grand takeaway from Sea Limited's incredible journey? It really feels like more than just a stock story. It's almost like a playbook for corporate resilience, wouldn't you say? A journey from these extraordinary trials to, well, a remarkable triumph, characterized by that dramatic pivot and some really smart strategic execution across all their core areas, e-commerce, payments, and gaming.
I think that's right. And the really intriguing aspect here, for me, is how the company's trials have made it a stronger company. That phrase really resonates. It seems to truly embody that concept of an anti-fragile compounder. A business that doesn't just recover from shocks, but actually gets stronger because of them.
Right.
Because it learned to operate with this unprecedented discipline and efficiency born out of necessity.
Yeah.
Which raises a final, maybe provocative question for you to think about. When a company goes through something like this, makes such a dramatic, difficult pivot towards profitability, how much does that experience bake in a unique kind of resilience? A long-term strategic advantage that maybe isn't immediately obvious just by looking at the current numbers of the valuation multiples. Something for you to mull on.